reminder that we love questions from the audience, so you can start commenting your questions now, or you can also add them as we go. I'll be right back on to welcome our guests to the show. Thanks for meeting us for coffee.
Good morning, everyone. Thank you so much for being here for the Meet Me for Coffee podcast. I'm excited about today. It just feels like a good time to check in and get a pulse on what's happening in the freight markets. And there's nobody better to do that with than Mr. Dean Croke from DAT. So excited to have him on the show. The only housekeeping announcement I have today is that somehow we are already in the second half of the year, which means if you haven't even started thinking about Manifest yet, you need to. So Manifest is technically in 2027, but that's creeping up on us. It's in February in Las Vegas. It's an amazing conference. It's growing. It's getting a little bit bigger every year, but they keep finding ways to create tracks specific to the topics that you want to learn about and how you can network with people that you're there to meet. And so while it is a very big sea of people, there's a lot of opportunities to get plugged in very niche market segments. So I will be there this year. I had to take a break last year. I had a newborn. And so planning to make it out and looking forward to seeing all of you there. So let me know if you'll be there and let me know if you'd like to save $200 on your registration. Just comment, shoot me a message. I'll put a link in the comments after the show to help you guys save a couple $100 on your registration. Okay. That's everything I had. I want to go ahead and bring Dean in this morning and see how he's doing. Dean, how are you doing this morning?
Terrific. Great. Good to be with you again. It's been too long since we've chatted or had coffee.
I know. I've had you on before, and I think time just flies for me because I'm always like, oh, we just talked a couple months ago. And then I go and I look back and it's been like a year and a half. So
wow. It hasn't a lot changed. Wow, we've actually got something to talk about.
Yes, absolutely. I mean, a lot's changed this year in short order as well, which I think I feel like it's more important than ever to have these market updates on this show every couple of weeks, have someone or every month talking about what's going on because, even the present state of freight today looks different than it did a month ago. And so things have been changing now, and we kind of broke out of that 3.5 year stagnation period. And now we need to know what's going on and we need to keep up. So I'm looking forward to having you help us out with that today.
Yeah. The speed of change has been, I think, what's caught everybody by surprise. The market has flipped hard and quickly. So we're in
Yeah.
this phase of the market where everyone's repricing, contract and spot freight fairly aggressively. And of course, the big question is, where is it going? And I don't know anybody's got that answer because we've got such a fragmented demand scenario as opposed to a broad-based demand scenario, and that's sort of making things a little bit difficult. Really depends on what sector you're in as to how well you're doing, I think.
Yeah. Okay. Well, let's jump in. Why don't you let's kind of stage set here. Tell me a little bit about what you see going on in supply side, demand side, and then I want to spend some time kind of talking about what you just mentioned, rates, contract rates, where we think things might be heading.
So I think one of the things we talked about at the start of the year when someone said, what do we think this year will look like? I said that I think it'll be where stabilizing demand meets constrained supply was the headline. And we said that generally means when we get to the bottom of this market in this equilibrium phase, we tend to see massive surges in spot rates anytime there's a market event. I listed 4 things. I said, avocados ahead of Super Bowl, Valentine's Day, Mother's Day, road check week. And I said, if we see rate surges around any of those events, we'll know that there is something to this supply-led pricing event, as in capacity is left largely because of a lot of the new enforcement and regulations. So that was the theory back in January, because remember, we were coming off 3 big weather events post-Thanksgiving that we largely attributed to the surge in spot rates. Well, we get into January, and then things keep going as we get into that softer quarter in the year. And then it became a different story because we started to see those predictions I made start to play out, and I won't go into the detail, but on road check week, we actually saw record levels of week over week changes in spot rates. Like reefer went up 30 cents a mile in that week. So what's playing out is pretty much what we thought would happen if there was truth to this. And I think I'll be honest and say, a year ago, I didn't think there was as many drivers out there that were either not qualified, had come through CDL schools they shouldn't have, couldn't drive a truck. We get into the whole English language thing, the immigration status, the non-domicile CDL, the jailbroke ELDs, which is another thing I didn't think about. I knew drivers that had falsified firmware that were resetting their 34 hours, doing a 34-hour reset every day, basically, and giving themselves a new bank of hours. I knew drivers that were doing that. I don't know back then that anybody knew how much of a deal it was, but clearly it's a huge deal now, because now we're getting into this phase where demand is fairly flat. It's up maybe slightly. Jason Miller's index is up, I think, maybe 1 to 1.4% year over year. That's a pretty good read on where things are. But rates are still holding in that 40% higher year over year. Now, to be fair, we've got pretty easy comps, right? Last year's rates were low and they're high, but I think the point is they stayed higher. Like they're tracking along with 2021, which was our previous record rate year, but that was driven by the pandemic. We've got a totally different scenario here where rates are tracking along 2021 levels, but not based on any level of demand that's equivalent to that. It's really because we've just got far fewer drivers to haul roughly the same number of loads. So we're in this sort of phase. You go on. Sorry.
Well, I was going to ask you, you bring up a lot of the regulation as reasons we're losing supply, but from my understanding, that's not done. That's not slowing down, right? And I mean, we haven't just quit enforcing ELP or cracking down on it. And then I actually just heard, I was speaking with someone at an asset carrier, and they just said that a lot of the non-domiciled CDLs are expiring this Q3 and Q4. So those drivers are still on the road. They just won't be able to renew when they expire.
Yeah, but I don't know those numbers are event moving, like market moving numbers, right? On the non-domicile CDL, because there was 194,000 drivers listed over 5 years in terms of the qualification period. So yes, it's a number. I don't know that that event alone will make a substantial difference, but I do agree there are still a lot of people out there that shouldn't be driving that fit this criteria of people that are skirting the law. and I just did 10 states and 5,000 miles in my truck on vacation last month. In fact, I was out in Springfield, Missouri, which was just south of you, I think, and at the ATS National Truck Show. And Samantha, I saw drivers out there that shouldn't be driving anything, not even a go-kart, like just absolutely horrendous. But it's not just minority truckers. Like, I think you need to be very clear about this. This isn't just a minority trucker issue. This is a national trucker driver standing issue, right?
Yeah.
There's some terrible drivers out there that are, American citizens and everything that goes with that. It's not just a particular segment of our population. I think it underpins this whole notion that we've got pretty bad training standards, and we've allowed a lot of drivers to come in that shouldn't, and training schools as well. So you could talk about that as a reason for the less capacity. But I think that if you sort of pull back and say, well, what's really happening? We've seen I call it the great recredentialing, because our entire industry is being recredentialed, whether it's drivers, companies, CEOs. You look at driver coercion regulations that the FMCSA is reiterating, the CDL standards, the EDL certification standards, withdrawal some of EDL providers. I figured, someone asked me the other day when I was on a show with Ken, when did I think the market had turned? What was the signal? The signal to me was the 26-state blitz in January on all of the states that weren't playing nicely with the federal government when it came to non-domicile CDL drivers. And so what we've had is effectively road check week all year. The road check week was a big deal, but it's well publicized and it's easy to get around that. But the rest of the year, in April, they had Operation Safe Driver in Florida, and they did something like 3,800 inspections and grabbed a whole bunch of drivers that couldn't speak English. Some should have been in jail. Some had felonies. It was a whole horror story. I remember Derek Bars at a conference in Washington at the JP Morgan event saying and showing a video of him alongside a driver, and this is in April, that didn't understand what a stop sign meant. So when you sort of raise the point about, well, there's more to come, I actually think that most of it's happened in the first 7 months of this year. It doesn't mean there's a lot more to come. I think there is, but I think if you had to say, who would still be out there on the road knowing all of this is going on right now, like as a driver? There are still some out there. And what I observed on my 5,000-mile journey across the country that sort of ended up in Denver, and then I worked my way all the way back to Boston, was that there are only 2 scales open that I had to pull into. 10 states, 5,000 miles, 2 scale houses open. So, but what was interesting was it wasn't the scale houses where the authorities were set up. It was little tiny rest areas in the middle of nowhere where you wouldn't suspect it. And they were pulling in everybody, not just trucks, but everybody. But this has been going on. If you follow social media, and I've got a substantial following in terms of generating intel, this has been going on all year, where the authorities, both state, local, federal, town, are out checking everybody's credentials. And so I think what it's had is it's had an effect where I think a lot of the people that were in the category of the chameleon carriers and the operators that were shouldn't be in the industry, I think a lot of them left and have gone. And I think this is why we're seeing rates hold so much higher year over year. And that's why we're going through this structural permanent change in the supply of drivers. And if you extrapolate this out one step further and look at all of these changes that are permanent, these drivers aren't coming back.
Right.
Like Shelley Simpson said it really well on her earnings call last September. She said it felt like the market had lost its elasticity. And that's exactly how I think we've ended up here. When you lose the elasticity in the market, anytime you see a surge in volume, rates spike because you don't have enough flex in the capacity pool. So, but if you go out into next year, the door that drivers come through just got incredibly narrow. Because of the permanency of these changes from regulation, not just federal, but states are now introducing legislation to, prohibit drivers that can't speak English. Training schools have to be delivered in English only. So it narrows this pool down, and it just means that finding drivers to do an awfully hard job just got even harder. And so it tells me that pay has to come up and rates will go up. But as being someone that owns a truck and still buys fuel and diesel and filters and stuff like that, this represents a step change in what it costs to run a truck, not linear. This is in inflation level CPI adjusted changes in the operating cost. I think we're about to see a step change because of what's happened. Because when you see sign-on bonuses and press releases around record high pay increases, it just tells me that into the future, that sticks, because on the back end of that, there's fewer available drivers, A, who want to come into the industry, and B, who can actually get into the industry. And Samantha, we haven't even got into hair follicle testing around drug testing, right? That's a whole nother level of restriction of available capacity, because the hair follicle testing picks up 5 times more positive marijuana tests than urine does, because it's a 90-day look back as opposed to a 5-day look back.
I have a question I've been wondering for a while. Correct me if I'm wrong, but you cannot get a CDL until 21 years old?
Yeah.
And I'm curious about that because specifically here in the US, when you turn 18, you pick college, you pick a trade, and you go.
Right.
And that's kind of the status quo.
Yep.
And so I've wondered, if that's going to eventually be something that gets re-reviewed, because it's hard to pull someone out of 18, 19, 20, 21. You're 4 years into a trade or a career, and you decide to go drive a truck instead.
It's always been the biggest problem. I think it's like a global problem where you've got people that can, you can't operate interstate. I think it's an important distinction. Interstate is sort of the 21, but you can get a CDL and work intrastate. I think that's the difference. But I think that this interstate is where everybody goes wrong, because there was a program, or is a program, going on where the FMCSA has got that Safe Driver Apprenticeship Pilot Program, I think it is, where 18 to 20-year-olds can operate intrastate, right? Now, the problem becomes, let's say you're in Quad Cities, Iowa, where you've got multiple states intersecting, or you could be in the southeast corner of.
I live in Kansas City, and everything in Kansas City is the Kansas or Missouri, 30 minutes either way.
So intrastate means that I couldn't go from Illinois to Kansas City, for example. And that's where I think this whole program is fundamentally flawed, because it shouldn't be about the designation of state. It should be about radius of operation. Because if I want an 18 to 20-year-old in my truck, I want to see him in and out of my yard every day. So it's about touch points. I want him on dedicated regional routes. I want him running from Kansas City to Springfield and back 5 times a day, or Kansas City to Topeka and back. I want to be able to have interaction, see how he's going, teach. So it's not about interstate. It's about the radius of operation that these drivers work in, and that they need to be in and out of a terminal so people can be interacting with them and training them. So I think that's where the system goes wrong, because we think about it the wrong way in terms of this state designation. But I'm a big supporter of getting new drivers in, because I think your point's valid. By the time you get to 18, you've already started to form your ideas about what sort of career you want. And if truck driving's one of those, there's a lot of barriers that pop up in front of you. I was just at a truck show on the weekend, the Gear Jammers show. We had 700 trucks and thousands of drivers here raising money for autism over the weekend. And there's a lot of young drivers there that would love to drive long-haul trucks. They're sort of enamored with this whole idea of a long-nosed Peterbilt with spread axle reefer and heading down the road, which sounds great, but it's incredibly tiring and frustrating at times. But they have no direct path to do that. Like there is a path, but these are folks that are probably going to find another job before they get into that sector of the industry.
Okay, so I think that was. We need to be having long conversations around the supply constraints that we're going to be facing and the available supply. And like you said, you also mentioned the cost to hire drivers is increasing. I think we're already seeing signs of that. I actually was just talking with a fleet and they said, I have 40 trucks.
Yep.
If you can give me 40
Mhm.
drivers,
Right.
I'll pay you. And I was like, well, I don't even know how I would go find drivers right now, So, I
It's
mean,
only going to get worse.
there's available trucks out there right now.
Mhm.
It's not even that equipment is the issue
Mhm.
or
No.
that the MC to run them under or the insurance is
Mhm.
there. It's set,
Yep.
it's ready. It's literally the butts in the seats that is the problem right now. So I
Well,
think that's something that we need to keep talking about just to help people
yeah.
understand where we're at and that the supply will have a lot of barriers to entry getting back in.
So getting back to the elasticity point, supply is going to be a long-term problem in the industry. I think in the spot market in particular around peak demand, I don't think it becomes a question of the rate. I think it is, have you got anything that's got rubber on it that I can put a load on first? Like, have you got available equipment? And then we'll talk about a rate. Because there's generally a notion that you can find a truck at any rate. Like if the rate's right, you'll find a truck eventually. I think we're fast getting to a point where there is just so few truckers out there that want to participate in this industry. Because this is a really difficult time for truckers because they're in the bullseye. For when you go out on the roads, like it's an awfully hard job from the
Sure.
traffic, the enforcement, the delays. We're in construction season right now. We've got 2 seasons, winter and construction season. We're in construction season. It's very hard to make good miles on some of those roads out there, particularly from where you live all the way through into Indiana and Illinois. Some of those roads are some of the busiest in the country, and they bring them down to 1 lane during the day. You can chew up a lot of ELD hours. So I think, but I have a feeling, and again, this is hard to quantify, but the driver supply issue, I think, only gets worse. I don't know you can throw enough money at it to fix it.
But
And
don't you also think that as it gets worse with time, I think the quality of life for
oh,
the trucking industry is improving. Like, I think this was such a necessary reset that we shouldn't be upset that it's happening. And I mean, I think our
right.
industry was getting out of control, Dean, is
Oh,
what it
yeah.
felt like. Like we were completely out of control, hence all the regulation that's having to come
Yeah.
in and fix what mess was created.
Yeah.
It was not on a good trajectory, and it was making it hard for people to make a good living because
Right.
the prices were low, the pay was low, the job was
Yeah.
hard. You're dealing
Yeah.
with incompetence around
Right.
every corner, and you got a spotlight on you now for safety and for maintenance, and
Right.
it's just it all got very taxing, I think.
Well, it did. And this is sort of that whiplash effect from the pandemic, right? Because a lot of this happened post-pandemic, this influx of capacity, training schools. Remember, we were moving fresh air at $10 a mile back during the pandemic. So that was a crazy period of time, and this tail of capacity that entered during that period, we're still seeing the tail end of that right now. So I absolutely agree that it was absolutely ridiculous what happened. But then on the other side, a lot of these folks had met the minimum criteria set by the government. So the FMCSA had to change its approach to this and make it much harder for all of the questionable operators to be in the industry. I just think that this is a very hard job. Like I've said all my working life that this is the hardest job I've ever done as a full-time trucker, not because of the driving part, but because everything else you've got to deal with it. And this is where I think carriers on the contract side struggle with this a bit, because you can throw massive pay increases at drivers, but if you can't get them the miles, you still haven't solved the problem. And I'll give you an example. I spoke to a shipper last week who was talking about not being able to find capacity, contract carriers rebidding their contracts from last year. They're up 10% already this year. Their contract rates are coming in 10% higher than last year. And I asked one question. I said, how long does it take your trucks to get unloaded? And they said, standard operating procedure in our bid, in our RFP is 4 hours. And I said, so hold on right there. So you're telling me that you've just taken away 10% of my available workday, because if 4 hours off a 14-hour clock means I've got 9 hours, I've got 10 hours to run on my 11. That's essentially what you're telling me, is you've reduced my available drive time by about 9%, and you're not paying me for that detention time. So what that means is that carriers are going to add a premium onto your rates to compensate for that. And it wasn't how they were thinking about it, because I said, you're on every carrier's 4-letter word list in terms of places not to go, or if you go there, get set for a long wait. And I think it disproportionately affects the spot market, where you've got a lot of live load, live unload, which is why it's affected the produce market more than any other sector. You've got drop trailer pools, it's a little bit of a different scenario, but you've got large fleets out there that would love to get 3,000 miles a week out of their trucks, but they really struggle to do that because of the inefficiencies in that sector of the business. And that's why I think the spot market carriers that are probably averaging 600 miles a day have been far more effective at surviving in that lean period that we've just come through. These are fascinating times.
I was just having a conversation with someone the other day, and they called out the fact that what we're seeing, it feels like food and beverage and industries similar are feeling the pressure to have to find capacity more so than your, call it, high value electronics, your aerospace. And it's because when we look at where a lot of the inefficiencies are with loading and unloading, or where were the rates pushed the lowest over the last 4 years.
Good point.
Even if you use the biggest fleets out there, they're going to start weighing the benefit of diverting some of that capacity away from you into a spot market or into someone else who needs a little extra data center support that's paying a higher price. So I think the people right now struggling the most from the shipper side are the people who had some of the lowest rates, and also now as rates are climbing are maybe offering some higher rates, but still not meaningfully improving those operational inefficiencies.
Well, I think I've often said that the gap between the rear bumper of the truck and the loading dock is where efficiency goes to die in trucking, because it's a black hole, literally a black hole when it comes to data integrations and efficiency. And the people at the dock aren't connected to the people in procurement necessarily when it comes to the cost of freight. But I can assure you every single driver is worried about time. Like, they're not worried about the rate per mile as much as they are about how long is it going to take me to get unloaded, get out of here, get to my next appointment, make 300 miles, get to bed, beat traffic, have a meal, have a shower, and get another 600 miles in tomorrow. Like, this is the stuff that goes on in their head. And I'll give you an example. When I was at Omnitrax Analytics / Qualcomm, we did some predictive analytics and text analytics work on freeform text messages in the cab of a truck. And what we found was one word popped up in 35% of accidents. One word from the cab to dispatch in a freeform text. One word. What do you think that word was? Take a guess. Truck sitting on a loading dock.
Detention.
Close. Waiting.
Waiting
was the word. So you think, okay, but there's just the psychology and the frustration of sitting on a loading dock. My record's 11 hours on a loading dock to load groceries at Woolworths in Sydney.
You get impatient. You get frustrated too.
There is nothing worse, because you have this hurry up and wait saying in trucking. Hurry up and wait. Like you'll.
That's what my dad says about women getting ready too, but trucking as well.
You'll bust your butt to get somewhere overnight, take incredible risks, take a lot of pride in your trip times and your truck, and you're there on time, and then you're told to wait, or we're not ready for you, or the load's not ready, we haven't picked it yet, or there's this, and there's nothing more frustrating than having your time wasted, because time is everything. I've only got 11 hours drive time and a 14-hour clock to make 600 miles to make my $1,500 paycheck, and don't forget, get home Saturday morning to be with my family. So that it's an incredibly stressful job. So I don't know that pay is one part of the equation, but I think it's secondary to the time management piece, and that's where it comes down to shippers who don't think about how long it takes to get their trucks on. I had shippers say the other day, what advice would you give to us? In terms of finding capacity, I said, get the trucks off your loading docks as fast as you can. I would do.
And I want to expand on that. If you're a retailer or some sort of distributor, you do need to figure out how you can understand how all of your vendors are doing at their
Right.
facilities. As difficult as that task might sound to you,
Yep.
I hear one retailer's name brought up consistently as to how frustrating it is
Mhm.
because you cannot get the pickup appointments scheduled, or the
Right.
POs are changing constantly, or you show up and you're detained.
Right.
And that's been like that for years with this retailer, and it's because there needs to be that control of
Yep.
that vendor,
We've seen the signs
base
on
as well.
social
Yeah.
media, 7 hours, minimum 7 hours to unload live loads in that big warehouse in California. Like
Yeah.
it's ludicrous to think that you can have a rate discussion with a contract carrier and not talk about the time component. I see a real disconnect there in the post ELD world. Even some drivers miss the point. They'll talk about a rate per mile, but they won't think about how long it takes to get the miles done.
Sure.
Because,
Revenue per hour.
revenue per truck day. If I need $1,500 per truck day, $2 a mile for a 2-day load doesn't work. If it's 600 miles, it's giving me, six. So anyway,
I think I would suffice all that to say that shippers are going to have to play a role in allowing the supply to come in making it an attractive industry and an industry of opportunity, right? Because for everything you've said, like for all the technology that we have and for all the planning that we do, we cannot just continue to create the problems that make people go,
yeah.
I just imagine someone being like, yeah, I want to go drive a truck in your first job, and you go and you sit and you wait and you wait and you're late and people are yelling and you're like, I'm done. You
I'm
might try
done.
1 week and be done. So we all have, all sides of this industry have a role to play in bringing in that capacity. I do want to ask you, Dean, before we run out of time today, I want to talk a little bit about rates and what is going on
Mm,
right now.
mm,
I also want to ask specifically about produce. You brought it up, and I think
yeah,
we had a pretty strong produce season. I think it was stronger than the last couple of years.
we
And so I
did.
want some quick
Yeah,
numbers on that and kind of tell us what you're seeing right now.
yeah, we're seeing. Let's start with the second part first, the produce season, because that kind of leads into where national rates are at. But produce rates, we just had a produce season, which again was a prediction we had at the start of the year, where we said that. In fact, I said to my CEO, who reported to our board, that it looks like we'll have a produce season. This was in January, based on a limb I went out on, a potentially career-breaking limb. And I said, I think we'll have a produce season, because back then I started to see this impact on capacity. And as soon as I saw that story about the CBS story about the California produce truckers not wanting to go to South Texas because of ICE and DHS setting up camp last September, and every scale house in Florida being turned into an immigration enforcement, I went, holy heck, this is going to impact produce season disproportionately, because those two areas are big areas where a lot of produce gets hauled out of. So produce rates back then from McAllen back to Los Angeles skyrocketed. They would like double. They've held a double since they were last September. They're up, I think they're up about 40 to 50%. So one of the things I did was I looked at the produce season rates. So my produce season is Vidalia onion pack date, mid-April to July 4. That's sort of when you materially see serious volumes. Over the last decade, spot rates in reefer. Now, remember, reefer rates in our world are all temperature zones in the trailer. So it's frozen right through to, produce at 34 degrees. And rates normally go up 23 cents a mile in that window. This year, they went up more than double, 50 cents. But produce volumes were lower. So on lower volumes, we had double the rate jump over that mid-April to July 4. So you say, well, how did that happen? Well, because of all the capacity that's left the market. So I went a little bit deeper into that, and I said, well, how does it really, compare? And I went to our top 5 states, which is like California, Florida, the Pacific Northwest, Arizona, Georgia. And outbound reefer rates in DAT's world ran about 19 cents a mile higher than the rest of the country. And last year, that gap was only about 8 cents a mile. So the produce growing regions on less capacity have higher rates than last year. And again, it's this year that we're seeing all of the enforcement action, not last year. Right, so we're seeing a big impact there. When you look at the USDA rates in particular, like just USDA only, those rates are up about 20% compared to last year. but California USDA rates, Samantha, up 51%, Southeast Texas 40%, Pacific Northwest up 20%. It doesn't matter what produce region I'm looking at, spot rates are much, much higher this year on lower volumes. And it's largely because, and this is my opinion, and I can't prove it with numbers, but all of the enforcement action has disproportionately affected produce growing region carriers, because I think long haul produce skews to minority truckers, particularly teams.
And I was going to just say that. I was going to say, and the fact that it's team drivers. So you're right that we typically see our long haul team driving sleeper cab trucks be more of those minority drivers. But also just because, and that I would expect that would continue, because if we're talking about a driver supply, they still want the team trucks. You have to find 2 drivers for every one of your trucks now. You have twice the battle that solo, fleets have now. So I would expect that will continue for some time, because, I've actually had, it's been a privilege for me working as a consultant with one of the larger team driving fleets in our space. And what I've learned is amazing. And how hard it is to find 2 people who want to share close quarters with each other for days and weeks on end, and keep everybody happy is not something that's easy to do.
Oh my God, it's the pits. I've done team driving in Australia. It's absolutely horrendous.
I don't know if I like anybody enough to want to spend that much time with them. I'm
driving a truck because I genuinely don't like people and I want to get out of my own. And I'm not saying now, but in my truck driving days, like if you're a bit of a if you're someone that just enjoys your own company, driving a truck is a wonderful thing to do. But sharing it with another person who you may or may not like is a really difficult thing to do. But the hardest part, though, Samantha, is trying to sleep in a moving vehicle, worried if the other person's awake, because that truck's going to run 21, 22 hours out of every 24. And, one of the things I did at CR England was kind of revolutionary. This is back when I was doing sleep science consulting. And I said, let's pair drivers based on sleep personality, not on music and smoking and where they live. Let's think about this a little bit differently, because what you don't want are 2 drivers of the same sleep type in the cabs. You don't want 2 night owls driving at the same time, because both want to work at the same time. What you want is a morning lark and a night owl paired in the cab, so one can drive till 2 a.m., and the other one can get up at 4 a.m. and function normally. And the results were staggering, right, in terms of the miles and production and accident reduction. And if you because what it means is you get safe production. It's production in terms of miles per month is one thing, but you need to do it safely, and that's why team driving is so hard. So there's lots of ways to tackle team driving. Very few people do this, Samantha. They arbitrarily pair 2 drivers, and they think they're going to get team production. I think it's the wrong way to look at it, because you've got to think deeply about the psychology and the physiology as much as anything else.
Yeah. Dean, we just had a great question. It's one I wanted to get to, I think, as well before. So thank you, Flavius, for your question. It said, for the remainder of Q3, in your opinion, do we expect the pressure on capacity and on rates to remain sustained and kind of see the same thing we have been navigating throughout the year? Or will we have a pause before we resume with the holiday surge for Q4? Now, I'm going to build on this real quick, because I was going to ask you about Q4. And you, I think, had mentioned to me that rates are just now starting to plateau. And so we've seen increase, and now we're kind of holding. And I was going to ask, should we expect another rate surge, because we don't see supply coming, and we're going to have any form of peak? I feel like at this point, call it a 1% increase in volumes, should see disruption in rates again. What are your thoughts?
I think flat to slightly down is how I'm forecasting spot rates. So remember, demand is fairly soft. So absent a surge in demand on the manufacturing front, we're going to see a lift in July from a record number of imports. So we're going to see around 2.5 million TEU come in, which sort of surpasses pandemic record levels, because of, shippers are generally worried about tariffs. So we're going to see a pull forward there. That'll create an air pocket in Q3 on the port front, which contributes a substantial amount of volume on those coastal markets. But I think as supply continues to This is a multifaceted answer. While ever diesel prices continue to surge like they are, and they've just gone up again in the last 2 weeks, that's going to keep a lid on capacity rushing back into the market. Because normally with spot rates where they are, you would have expected a substantial surge in new capacity. Now, there is capacity coming in, but not at the rates that you would normally expect. And so I think what we'll see, if we see volatility in the oil markets because of the Middle East conflict, that will have a slow trickle of capacity coming in, offset by a slow trickle of capacity leaving from all of the illegal carriers. So absent any surge in demand, I think we're going to see rates flat to slightly down all the way through Q3, which again is a seasonal phenomenon. Rates normally cool from now all the way through into Thanksgiving in particular.
Can I ask though about contract rates in Q3, because those are just now getting reworked, and I think carriers still know what's coming in Q4. So I would expect to not see any dip in contract rates.
Oh no, so I'm talking spot rates there. So if you want to talk contract rates, that's a whole different scenario where you've got those rates are going up right now almost exponentially. So if I look at our new rates coming into routing guides in the last couple of weeks, up 9% in dry van, about the same in reefer, and up almost 14% in flatbed. So new rates are coming in, substantially higher than they were a year ago as carriers rebid all of those contracts. The average over the first half was about a 10% gain in contract rate pricing compared to the same period last year. So I think we'll continue to see that rise as contract rates catch up with where spot rates, are pushing the market for the rest of the year.
Okay. And then as far as volumes come Q4, are we thinking normal seasonality, normal peak season?
Yeah, I just don't. So I don't know any analyst that'll be able to figure this one out, because we've got such a fragmented economy where AI data infrastructure is doing such a, heavy amount of volume work as opposed to other sectors. We haven't got a broad-based demand economy. That's why our flatbed rates in open deck are so high, because of all of the AI data center infrastructure work into those sort of 18 freight markets where data centers are concentrated, whereas single-family housing numbers are heading south. So that's why I think demand is still relatively flat and soft in some sectors, but surging in others. And until we see a major inflection in our economy, where demand is sort of more broad-based, I don't think we'll start to see another step change in spot rates. So I think my prediction is spot rates have gone up substantially, but then we'll start to level off and plateau. But you will still see, break tech week's going to come up soon. You're going to see another surge in rates there. Public holidays will create a tightening of capacity. The peak retail season getting into November and Thanksgiving, you'll see spikes in spot rates about there. But you have to draw a line between now and the end of the year. I still think rates are going to be fairly flat from here on in. But still higher year over year, but still relatively flat because of the demand scenario.
Okay. Hopefully we answered that question. That was a great question. So thank you. Thank you for asking. And I also think that a takeaway from that answer would be, if I'm a carrier, I need to understand, the freight I'm exposed to right now. Like, even if you're partnering with brokers, are you partnering on their contract lanes? Are you partnering on spot volumes? What is it that you're moving? And that'll kind of help you gauge how you should think about your own pricing and what you're offering.
Yeah, I think this is a good time to be talking about relationships and partnerships and commitment, because yesterday I was on a podcast and the shippers were talking about how carriers have suddenly got no memory of how well shippers treated them during the pandemic, because they're going back rebidding contract rates and not remembering how well they were looked after when things were bad. And I thought, wow, this is fascinating, because the tendency
that was 4 years ago?
Right.
So for the last 4 years, that memory, I don't know about that one.
Yeah. So but I think the difference is for carriers this time is it's going to be a very, capacity is going to be very hard to bring back on at scale, because of all the regulatory changes and the cost of diesel and the cost of insurance and finance. And so for shippers, finding good carriers and looking after them is going to be critical. For brokers, I said to some brokers the other day, your private network, you've got to treat like gold. They are the lifeblood of your business. You want to hold on to every single one of those you've got.
I have some carriers that their brokers are talking to them on a weekly basis right now.
Yeah,
Like,
absolutely.
hey, what do you need? Do you need anything? How are things going? How are rates going? And I mean, that's the truth. Like, everyone needs to be really focused on that. And also, I think, what we talked about at the beginning of this show, that we needed this kind of industry reset for the trucking companies.
Yeah.
It is going to come with a rate increase. That's really not a question in my mind. And so I do think that we are moving the baseline up for rates. And so that comes with these contract renegotiations, and that comes with everyone's budgeting for what they're going to be spending on transportation. And it's just kind of time to everyone handle this in stride and with their partnerships in mind. But it's not something we're avoiding. Anybody's getting out of this. So
yeah, and I think from operating a cost perspective, we're still not where we need to be completely viable as a owner-operator, small fleet operator. So I think there's more room to go before we get to a level where things are sustainable. And as a carrier, I can provide you with a service 52 weeks a year.
And you can hire drivers and offer them a quality job.
Pay them properly, have them home when they need to be home, all that good stuff. And have a long-nosed Peterbilt with a bit of stainless steel on it. That'll make all the difference.
Awesome. Well, Dean, thank you so much for taking the time this morning. This was my first cup of coffee I've been working through. So you really did meet me for coffee this morning. I appreciate that. And thank you to our audience. It was nice seeing you. So we had some people in the comments, Dima, Bilal, Flavius. Thank you so much for being here, for letting us know you're here. We enjoy seeing who all is listening in. So if you guys listen back to this later, drop a comment and say you listened and let us know. Ask any questions. Yeah. Dean is on LinkedIn. He's easy to find. He's out there on social media channels. Go look him up, follow him, connect with him. If you have questions about anything you guys heard today, please reach out to him. Please reach out to myself. Leave a comment here. Tag us on the show. We'd be happy to answer any questions for you guys.
Absolutely.
So, Dean, I appreciate it again. Thank you for making the time. Let's not wait like a year or two, to do this again sometime.
Yep.
I'll try to be quicker.
Yeah. Thanks for having me.
All right. Absolutely. Well, thank you everyone for meeting us for coffee. We enjoyed it.